Worker classification might seem like a simple administrative detail, but it can have major financial and legal consequences for both businesses and workers. The distinction between an employee and an independent contractor affects everything from tax obligations to workplace protections and benefits. Misclassifying workers is one of the most common and costly mistakes businesses make. The IRS, Department of Labor, and state agencies are increasingly cracking down on companies that incorrectly classify employees as independent contractors. At its core, the classification hinges on the relationship between the worker and the business. While employees work under the direction and control of their employer, independent contractors maintain autonomy over how they complete their work. Several legal tests are used to determine proper classification. The IRS uses a 3-category system examining behavioral control, financial control, and the type of relationship. They look at who controls the work, who bears financial risk, and the formal structure of the working relationship. Many states, particularly California, use the more stringent ABC test. Under this test, a worker is presumed to be an employee unless the hiring entity can prove the worker is free from control, performs work outside the company's usual business, and is customarily engaged in an independent trade or business. Employees typically work for one employer during set hours. They receive benefits like health insurance and paid time off. The employer controls how, when, and where work is performed, and provides the necessary tools and equipment. Employees receive regular wages with taxes withheld by the employer, including income tax, Social Security, and Medicare. Employees are also entitled to unemployment benefits, workers' compensation, and protection under workplace safety and anti-discrimination laws. They can join unions and are covered by minimum wage and overtime regulations. Common examples of employees include administrative assistants, retail staff, company software engineers, marketing managers, and delivery drivers using company vehicles and wearing company uniforms. Independent contractors, by contrast, often provide services to multiple clients and set their own hours. They work from their own office or home and don't receive employment benefits. Contractors have authority over how they complete tasks without employer input and bear all costs associated with their work. Contractors are responsible for their own self-employment taxes and aren't subject to tax withholding. They aren't eligible for unemployment or workers' compensation benefits. They supply their own equipment and tools and can typically be hired and released according to the terms of their contract. Freelance writers, IT consultants, self-employed tradespeople, rideshare drivers, and marketing consultants operating under their own business name are common examples of independent contractors. The tax implications of worker classification are significant. For employees, employers must pay state and federal unemployment tax, Social Security tax, workers' compensation, and disability insurance. For independent contractors, the hiring entity has no such obligations. Misclassification can lead to severe penalties. If an employer unintentionally misclassifies a worker, they may face penalties of 1.5% of employee wages for federal income tax withholding and 20% of the employee's share of FICA taxes. Intentional misclassification carries much steeper consequences, including the full amount of income tax that should have been withheld, the full amount of FICA taxes for both employer and employee, plus interest and penalties. Civil and criminal penalties may also apply. Multiple government agencies enforce proper classification. The Department of Labor enforces wage and hour laws, while state agencies handle unemployment insurance and workers' compensation rules. California aggressively enforces its ABC test under Assembly Bill 5. To avoid misclassification, businesses should regularly audit their workforce classification policies, use clear written contracts, avoid treating contractors like employees, and stay informed about evolving state laws. Businesses cannot safely classify a worker as an independent contractor simply because the worker requested that status, signed a contract, works sporadically, is paid by commission, or completes assignments for multiple companies. The actual working relationship, not paperwork or preferences, determines proper classification. Some industries face heightened scrutiny regarding worker classification. Construction, healthcare, transportation and delivery services, and media and content creation frequently encounter classification challenges due to their business models and work arrangements. Understanding the distinction between employees and independent contractors is essential for compliance with tax and labor laws. When in doubt, the safest approach is to classify workers as employees or seek professional guidance from an attorney or accountant. The IRS Form SS-8 can also be used to request an official determination of a worker's status. Proper classification protects both businesses and workers, ensuring appropriate tax payments, access to benefits, and compliance with labor laws. Taking the time to get classification right can prevent costly penalties and legal complications down the road.